If you're trading both directions in the same session, that usually means one thing. You never defined your bias. Today, I'm going to show you how to build a clear daily bias so you stop reacting and start executing with intent. Welcome to the Ascension Trading Series, Phase 2. If you're new to trading, you're probably wondering, what is a daily bias? All it does is answer a single question. Am I looking for long setups today or shorts? This doesn't mean price can't move both ways, which in most cases it does. It just means you offer yourself a higher probability when trading with the direction of the overall market. So bias is based off structure and context, which gives you clarity, patience, filters your trades, and offers fewer impulsive decisions. Without the overall bias, literally every move in either direction seems to be tradable. Some common mistakes this lesson will help with is not forcing a bias when you want a direction, ignoring higher time frame structure, or trading both directions. Most traders struggle with bias because they drop down to the lower time frame immediately and then get chopped up by all the noise or fight the true direction. Lower time frames show reaction, higher time frames show intention. If you don't start with a top-down analysis, you're trading blind. Using a daily bias doesn't mean the next day is expected to close green or red. Rather, it's the direction that the market's more likely to head, which increases your probability of a winning trade. Before we start with all the information, I would suggest getting something to take notes on so you can look back on them later. So here's my exact process. Open up the daily chart, and what I look for to determine the current daily bias is how yesterday reacted to the day prior. So realistically, I only need the previous two candles to determine the next one. The determining factor most of the time is how yesterday closed in comparison to the prior day's high or low. For example, if yesterday fell below prior's low, but managed to close above it, this indicates a bullish bias because it refused to close below the low. Again, this doesn't mean that the new daily will close green, it just means there's a higher probability of your trade winning if you take longs. Now, this doesn't confirm the bias that we'll be executing on until we drop down to the 4-hour time frame and get the overall narrative, but this is where you begin each day. And we'll go over the 4-hour narrative once we go over my strategy, the Zenith model, later on. For now, focus on understanding how to derive bias in itself. From my experience, I've discovered 4 patterns that lead to which bias should be used. The 2 basic candle formations that determine bullish bias are when the daily goes above the prior's high and closes above it. The other would be when the daily goes below the prior's low, but closes above that. The same 2 basic formations apply for the bearish, but they'd be opposite. For example, when the daily goes above the prior's high, but closes below it. Or, if the daily goes below the prior's low and closes below it. These should be pretty straightforward. If price fails to close across the high or low once taking it, that's indicating the opposite direction for the following day. There's 2 more patterns that aren't so straightforward. These take a little bit more to understand. The first is what's called an inside bar. It's when the daily closes without sweeping the high or low. So how do you determine where price will go the next day? Since price never took the prior's high or low, you assume there's no indication. Except there is. Let me explain. If the daily closes as an inside bar, you simply inverse the prior day's bias. So in this instance, you'll need 3 candles to determine the bias. The first is used in determining the second candle's bias. The third, which would be the inside bar, is simply inversing whatever the second candle's bias was. For example, candle 2 sweeps the low of candle 1 and closes above. What would be the bias here? Bullish, because it failed to close below the low after sweeping it. Now candle 3 closes as an inside bar. Since candle 2's bias was bullish, we inverse this for the next day. So our current daily bias would be bearish. The last pattern would be a candle where the wicks engulf both the prior day's high and low, but closes back inside the prior day's range. Again, how would you determine where price will go if both sides have been swept and price didn't confirm direction by closing across either one? This one's a little easier to grasp. However that engulfing wick candle closed, inverse its closure for the next day. So instead of focusing on the prior day's bias, like an inside bar, you inverse the actual daily candle's close. For instance, if it closes red, the next day would carry a bullish bias, or vice versa. I'll walk through a few examples with you. I would also suggest getting some practice in yourself, so I'll leave a link to TradingView in the description below. Since we've already derived the bias for this day, we'll look at the one before. So to determine this bias, we'll need to look at yesterday's close in comparison to the prior day's candle. So this one opened up, it didn't sweep the low, went up, swept the high, and closed below it, indicating bearish bias for this candle here. Looking at this one, go back to yesterday's candle and how it reacted to the day before. It opened up, didn't sweep the high, swept the low, closed above. This candle would be bullish. An example of the inside bar would be this candle here. As you can see, the low and the high were never swept. So to determine how we go about the next day, we have to look at this candle as well as this one. This would be candle 1, this would be candle 2, which opened up, went above the high, closed above it. This will be a bullish bias going into the next day. Since this closes an inside bar, we inverse this for the next one. So we look for shorts on this day here. You can also draw some visual aids by simply grabbing a horizontal ray and just marking out the day you're looking to determine. That way, you can look at yesterday's candle and the prior and make note of what the current day's bias is. So from this point, we've swept prior day high, and we've also swept prior day low. So as you can see, both high and low have been swept, and we closed back inside the range. This candle closed blue, which is green for me, which means that would be a bullish bias, but since it engulfed both sides, you inverse it. So we're looking for shorts on this day. Deriving daily bias isn't to predict perfectly, it's to align your trades with the highest probability outcome. Once you determine the bias, only take trades aligned with that. If there are none, great, go enjoy the day, no trades, it's not an issue. If you miss a move that goes the opposite direction, again, who cares, it happens. Your job isn't to win every trade. Winning 100% of the time is impossible, but that doesn't mean accepting a 37% win rate. The goal is continuous improvement. And improvement doesn't mean changing your strategy after every loss or convincing yourself nothing works. That's emotional reacting. It means this: if a loss followed your process, accept it. That's part of the game. If a loss happened because you broke your rules, own it and make sure it doesn't happen again. That's how you actually get better. Bias changes your execution because you avoid setups opposing your direction. You learn patience and wait for pullbacks. You align with strength. You stop trying to catch moves that aren't there. Bias simplifies everything, so you're not fighting the trend. Now, this doesn't mean your bias is guaranteed to offer a setup every day, but when it does, it's more likely to offer a win than a loss. Of course, the bias can be wrong, and that's fine. This is a framework, not the market's destiny. If structure shifts, you adapt, which you'll learn when I go over the 4-hour narrative. Professionals adjust, and amateurs argue. In the next coming lessons, I'll break down some pretty popular smart money concepts like fair value gaps, S&T, changing the state of the delivery, along with some other Elliott wave theory. If you're serious about ascending as a trader, be sure to subscribe so you don't miss the next lesson. And if you want to go deeper with traders who are building real discipline and keep you accountable, you're welcome to join my Discord, The Summit, from the link in the description. I'll see you guys in Phase 2, Lesson 2.